Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast, where we provide constant improvement to businesses through timely, actionable financial solutions. Do you want answers to your financial questions? Email us at bsp@kaizencpas.com. I'm your host, Mark Valesky. Now let's get started. Welcome to another episode of Kaizen Time. I'm joined by Eric Jorn, a partner here at the firm. Eric, what's an HSA?
What is an HSA? HSA is a health savings account. Important distinction here. An HSA is not a health reimbursement arrangement, which it's commonly confused with.
Say that again.
An HSA is not an HRA, health reimbursement arrangement.
Okay.
So HSAs are a separate savings account in which you specifically designate funds for medical expenses. The biggest quirk is you need something called a high deductible healthcare plan. So your healthcare plan needs to be actually compatible with an HSA. So you can't have the non-deductible PPO plan, Cadillac plan, and go open an HSA as well.
Yep. Does not work with the low end HMO. It's usually higher premiums.
Exactly. Yep. A little bit higher deductible, a little bit higher premiums. There are very specific stipulations around the minimum deductible to qualify and also the maximum out-of-pocket max. And then it's got to generally meet minimum essential coverage criteria. You can almost always get the answer from your health care plan provider, whether or not it's compatible with a health savings account.
Okay.
So the biggest distinction or confusion people get is they always think, am I going to lose my money I put in this if I don't spend it by the end of the year?
Wait. I know the answer for this one. No.
That's correct.
It is your money.
Correct. That is forever your money. And we're going to talk about why keeping your money forever in that account is a really smart idea.
I am almost certain it's going to be to avoid taxation.
The really cool thing with HSAs, the only vehicle in which you can hit triple tax-free benefits.
And what does that even mean? What is triple tax-free benefit?
Yeah. So let's think about other different tax advantage vehicles like retirement plans.
Okay.
So you have a traditional plan where money goes in tax-free, but when you pull the money out, you pay tax on it. Conversely, you have, say, a Roth contribution where you pay the tax up front and then the money grows tax-free. And when you take it out, it's tax-free.
Okay.
Well, an HSA is an account in which you can put money in tax-free, and that's avoiding both income tax and FICA taxes. That money can grow tax-free inside of the account, so you don't pay any tax on that money inside of the account. And then you can actually distribute that money out tax-free as well. So it's money in which you can grow without paying tax on it at all.
That sounds phenomenal.
It is a little wrinkle of in the tax law, and not enough people, I think, take advantage of it. Now, there's a lot of things that need to happen and align for you to actually realize all those benefits, but it's definitely doable.
Okay. So let's get into the things that people really don't know about it. Obviously, this triple benefit is phenomenal, right?
How do I go and execute this, right? Yep. So you might be at a few different stages if you're listening, right? Stage one might be, I don't even have an HSA set up. So say you go and actually, we're right around or right past open enrollment season, depending on who you're for or who
you're employed by.
Yes. Yep. So good time to figure out whether or not I can participate in the plan in an HSA account. If I can, maybe it's been funded, or maybe I still need to fund it. So get the money in there. I think there's around a $4,000 individual contribution limit and $8,000 family limit. Those will go up in 25 and change. If you're 55 or older, there's a $1,000 catch up as well. So that you can get that kind of money into the plan. It's not a huge amount, but this is again a long-term play.
I was about to say, this is something, and we talk about it all the time on this podcast, building up. It's sustainable, and it can be big savings then over time.
Exactly. So we get the money into the plan. Now, what do we do with it? So certain HSA providers allow you to take that money and invest it into the marketplace or into the stock market, or have regular funds or whatever it may be, a list of investment vehicles. We'll use HSA Bank, or a lot of the brokerage account firms also provide HSA accounts where you can go and put it into an S&P fund, and you're going to retain, or you're going to get growth ideally over the long period of time. If you look at the long-term trend for an S&P fund, it makes around 10% a year.
Which is more than you're ever going to get at a bank.
Exactly. So money's in there. Now it's getting invested. You're earning you're earning gains on the funds within there. Mm-hmm. Now you incur some medical expenses. So what do I do then? Conventional wisdom says I have an HSA account. I incurred medical expenses. Why don't I just use that account?
Yeah.
Not what we want to do.
This is going against my conventional wisdom.
So the trick here is to actually pay for that medical expense out of pocket, outside of the HSA.
Okay.
Because one of the things that an HSA has is something called an unlimited look back period, meaning you can wait 40 years to reimburse yourself for medical expenses that you've incurred over the last 40 years.
I feel like that's a really long time.
Yep.
But okay.
Yep. Again, and that's an extreme example, long-term play, right? So with it, you're letting that money continue to grow tax-free for that 40 years. And then you're reimbursing yourself at the end of the period for whatever medical expenses that you've incurred. Mm-hmm. And then once you hit retirement age, you can actually withdraw the principal portion of your HSA account tax-free as well. So we essentially, if you incur medical expenses throughout your 40 years, mm-hmm. and you add all those up, and then you also, on the flip side, draw back your initial contributions. Once you hit retirement age, theoretically, you could pull all your money out of your HSA tax-free in a lump sum at retirement that has grown throughout that period of time tax-free.
So let me get this straight. I wait 40 years.
Yep.
Or just short of it, just to be safe. I've been paying out of pocket, more or less, for all my bills, letting my HSA bank account grow.
Yep.
Feeding it, and then reimburse myself.
Correct.
At the tail end, right?
Yep.
So all that money just basically goes straight into my bank account.
Correct. Tax-free.
That's the key word right there. Tax-free.
Yep. And remember, we put the money in pre-tax, right? We either got a deduction for it or it reduced our taxable wages on our W-2. Mm-hmm. The money sat in there and it grew every year without paying tax on it. And we took the money out and it now became liquid cash, tax-free.
So there's a few questions that I have for you. Because one, this can change, right? 40 years is a long play.
Sure.
And tax code changes
absolutely
every couple weeks, it seems like.
There are a lot of changes in tax code, and we're probably looking at a major tax overhaul in the next couple of years.
Yep. So I think it's something.
Mm-hmm.
But the other thing I want to ask about is the growth of the HSA account. So not a lot of plans offer something that allows you to grow the account, where it can be connected to stock market, whatever.
Yeah.
Want to go into that?
Yeah. So really that's just who your provider is. Like who did you open your health savings account with? Again, we have no affiliation or anything with HSA Bank, but it's an online system and they have access to all the funds. I believe Morgan Stanley has one. All your big brokerage account providers generally have an HSA option, but the key is you actually have to go and invest the money, right? Yep. So don't think just because I contributed it to this account and it has these available
that it's actually doing it
in the market. And a lot of, for the most part, you have to have an available amount of cash balance in the HSA, and the rest can get invested. It might be $1,000 or $2,000 before you can take the incremental amount and put it out into the marketplace.
So really, this is that long game.
Yep.
Is what you're thinking.
Yeah. So consider somebody that's starting their career or whatnot. They're putting money in every year for the HSA. I believe if I've done the math, and I believe it would amount to around a $500,000 or $600,000 balance if every year you contributed the max amount to an HSA over a long period of time. I think this is a single contribution amount too. You would have about $500,000-$600,000 of income or of money you can pull out tax free at retirement.
It's a big lump sum too.
A big lump sum, and again, triple net tax benefit. The only thing that actually has that effect.
I guess my only question is then, I mean, so you're throwing all this money in, and the only way you're getting it out is by reimbursing yourself.
Correct.
So that's the only trick. It's not just money you can pull out at willy-nilly, right? You can't buy a house with it just because.
Correct.
Unless that house was paid for by your surgeries. It sounds awful.
Yes, exactly. Yeah, and that is record keeping is very important, right? Obviously.
Actually, that's a great question for me to ask. Record keeping for 40 years. How's that going to work?
Yeah. I mean, it's a challenge, right? Obviously, is to compile those records and have them on hand for that long period of time to take that lump sum distribution. We do have really good cloud-based systems. I don't know of a solution in the marketplace currently that says, hey, I will store digital receipts for you for 40 years.
So Eric, are you starting a new business now? It just
Maybe
might be.
We could find a little tag along. I mean, this is a very niche tax planning topic. Not sure the R&D works super well on that, or we'll get a good ROI on it, but maybe.
As we close this, I just want to say my next house will be brought to me by my lower back surgery. Let's just say it right over the door.
It will fund your down payment.
What are the vertebrae called? Whatever, like a C7 or whatever.
Yeah, I think so.
This is brought to you by blah,
Disc
blah, blah.
C7.
Yep. Awesome. Is there anything else, Eric?
Yeah, one little wrinkle that you have to also know is that to reimburse yourself for an expense, you have to have had enough money in the account to cover that expense. So in your first year, say you get a $10,000 medical bill and you had no money in that account, you cannot, even though you had the account, and you cannot reimburse that $10,000 back to you. Obviously, once you go down the line, you accumulate the balance, right? And again, this is on the long-term strategy outlook part. Generally, you're going to be young. You're not going to incur a lot of medical expenses early on. Hopefully, you build a nice, secure amount of money into this account before you start getting older and incurring medical expenses. And therefore, you already have the balance established. You can essentially qualify for those reimbursements over that long period of time. And then once you reach retirement age, realize that really nice benefit. And, if you do a 35% tax savings on about a $500,000 or $600,000 balance, $170,000 tax saving trick.
Triple benefit.
Absolutely.
All right. Thank you, Eric.
Thank you.